Okay. This video is on liquidity. Liquidity is the second most important thing in the market besides news, right? So, I want to get this very clear. Do not overcomplicate liquidity. Liquidity is simply highs and lows. That's it. Liquidity is highs and lows in the market. Don't worry about anything else. That is where money is sitting, right? At highs and at lows, right? Let me mark out some highs, right? Here's a high. Here's a high. So think of it like this, right? Liquidity is a magnet pulling price to a certain level, right? So right here we see a break to the upside after this candle closure, which I'll make a whole video on break of structure, but for now I'm going to have to use that term to describe liquidity. So we see a break of structure to the upside, therefore we are in an uptrend, right? And the break of structure is right after this candle closure right here. So that created the break of structure to the upside. If we are in an uptrend, we are targeting buy-side liquidity. We are targeting the highs. If we are in a downtrend, we are targeting the lows. So for this example right here, the first example of many, I'm going to do many, we are in an uptrend, therefore we are targeting the highs. Again, think of it like this. This high is a magnet pulling price up to it. It is grabbing the price and is pulling it up as strong as it wants. Because this is why. I'll tell you exactly why. You see selling pressure right here with these black candles, right? People are going short at this level, right? Right here, bang. Because they see a break of the low, they're going short. And they're putting their take profit wherever the low is. Way over here, right? They're putting their take profit at a low. And they're putting their stop loss at the high. Say it doesn't quite hit their take profit, and market reverses on them, right? And then stops them out. That's exactly what the market wants to do. The market wants to stop out people that are pre-firing orders. So people who went short here, yes, they could have potentially banked a trade, which they probably did, but say they didn't. Say they had their take profit down here, and they ended up getting their stop loss hit. That's what the market likes to do, right? So after a break of the high, right here, this high is pulling price up like a magnet, right? This high is pulling price up. This high, this high. Because we are in an uptrend, we are targeting the highs, right? And in a downtrend, we are targeting lows, right? So right here we see a downtrend. So lower highs and lower lows indicates a downtrend. So here's a high, here's a lower high. Oh, oops. I'm on an eval right now. I did not mean to do that. Okay, let me redo this. Here is a high, and then here is a lower high, and then here is a low, and here is a lower low, indicating a downtrend. Lower highs and lower lows means downtrend. Higher highs and higher lows means uptrend. So in this case, we are in a downtrend. So guess what? We are targeting sell-side liquidity. Think of this low right here as a magnet pulling price down because we are in a downtrend. We are in a downtrend after a break of this low right here. A candle closes below this low right here. That's our entry. Bang. Right there after the candle closes. Wait for a candle closure. You have to wait for a candle closure. If not, you may get stopped out, right? Because price can just wick right here, and this candle could have went straight up, right? It could have, but it didn't. And we know it's not going to after a candle closure under the low right here. Coupled with an inverse fair value gap, which I'll make a whole video on, a whole separate video on as well, with a break of structure video, inverse fair value gap video, order block video. I'm going to make all these videos, but for now we're focusing on liquidity, but I still have to use these terms because that's how I understand it, right? So we see a break of the low with this candle right here closing under this low, indicating a downtrend, right? So guess what? We are targeting sell-side liquidity in a downtrend. Again, this is a magnet pulling price down. I'm going to say it a million fucking times. You guys have to understand this. In a downtrend, we are targeting sell-side liquidity, right? So our entry is right here at the inverse fair value gap. Bang, right here. With stops at the in-turn highs, right? I don't want to put my stop loss here, and I don't want to put my stop loss here. Because if I'm wrong, I want to be wrong immediately, right? If it breaks this high, it's most likely going to come up to this high. So why would I risk more money if I know it's going to hit my stop loss? So I'm putting my stop loss at the intern highs because, like I said, if I'm wrong, I want to be wrong immediately so I don't lose as much money. As a trader, you want to lose as little as possible while making as much as possible. So I put my take profit here, which would be a 1 to 2 risk to reward. Amazing trade. But again, we're just targeting liquidity, right? So let me just I'm going to do like 5 more examples. I'm going to have to. I really want you guys to understand this because as a mentor and as a teacher, it is my job to make sure you guys understand this and you guys become profitable. That's my job. I need you guys to do this and understand this completely. So I'm going to do a bunch of examples. It may get boring, but I want you guys to listen. Let me just go to random 9:30 market open. Bang. 9:30 market open right here. Immediately we see a sweep, or almost a sweep of this low, right? So that's the manipulation leg. Market likes to open and manipulate to trap, in this case, to trap sellers. Market opens and manipulates down. People are selling right here, right? They're getting FOMO. They want to catch the move down, but they don't know it's the manipulation leg. So people are selling here, and they're putting their stop loss at these highs right here. I'm teaching you guys not to do this, right? Stupid, dumb traders that just got in the markets, they're shorting right here. Do not short here. You see this momentum, and then they're putting their stop loss at these highs, right? That's the manipulation. They want to catch you in shorts. Doesn't quite sweep liquidity, so I'm going to do another example after this. But it manipulates down, almost sweeps liquidity, not quite. Market likes to come up, because we are in an uptrend. Here's a high. Here's a higher high. Here's a low. And then here's a higher low, indicating an uptrend, right? But people are going short here, you can tell, because there's selling pressure, right? Selling pressure means shorters, sellers. So the sellers are putting their stop loss at the highs. So after the market manipulates, it comes up and stops out all the sellers. They don't want nobody selling right here. Dang. So since we are in an uptrend, I want to get this very clear. Since we are in an uptrend, we are targeting buy-side liquidity. Buy-side liquidity are the highs. The highs are magnets that are pulling price to that level. This high is a magnet pulling price up to it. And you can tell. Price just blew through it, right? So as a professional trader, your job is to not get the manipulation leg, but to get the continuation leg or distribution leg, whatever you want to call it. So your job as a trader is to wait for a liquidity sweep. So right here, we almost get a liquidity sweep. And we wait for a break of structure to the upside, which we get after we see a candle closure above the previous high. Right here with this blue candle right here. Closes above this high, therefore means a break of structure to the upside. We are now in an uptrend. What do we do in an uptrend? We target buy-side liquidity, we target the highs, and we think of it as a magnet pulling price higher. Mark out these highs. Mark out these highs. Fuck it, we're marking out all the highs. Because we're in an uptrend, right? But me, how I trade, I want to get a small piece of the pie, right? I want to get in and I want to get out as fast as possible, and I want to profit. So after a break of this high right here, I'm getting in immediately. And I'm putting my stop loss right under the fair value gap. Which, like I said, I'll make an entire video off of that, right? So this 1 minute candle manipulates into the fair value gap, and then we see a candle closure above the high. That's where I'm getting in after the candle closure. That is very specific. You guys have to wait for candle closures above or below wicks. Otherwise, price may wick up and just tank, right? But we know it's not going to do that because the candle closed above the high, indicating an uptrend, right? So at that point, we have a partial take profit at this high, this high, this high, and then obviously these highs over here, these highs. We're putting partials, right? But how I like to trade, I just like to go full take profit as soon as I can at the next high, right? And most likely I would have just gone right here, right? Just sort of 1 to 2 risk reward, right? It doesn't matter, okay? Yes, I hit my take profit immediately. That doesn't mean I'm sitting here trying to get back in on buys because we have no confluences. We already had our break of structure to the upside, and we already have our candle closure above the high. We just want a small piece of the pie. The higher the probability of you winning, the better, right? So if I put my take profit here, a way higher probability than if I put my take profit fucking to the moon, right? To these highs, right? Way better chance that I get my take profit hit down here. And we want higher probability setups. We want to win more than we lose. That's pretty much it. I'm gonna do a couple more examples. I'm just gonna go to random day 9:30 market open and let's see if we can get a good one. Okay, this is a choppy day, so people do not like trading with choppy days. So let me explain this chop right here. Okay, whatever, 9:31. Let me zoom in so I can accurately do this. 9:30 market open. Okay. So yes, this candle closure right here indicates a downtrend, right? We see a candle closure under this low. But guess what? It was during pre-market. Fuck pre-market. I don't care about pre-market. I care about market open. What does the market do when it fucking opens? It opens and sweeps the highs. That is what we're looking for. Manipulation higher to sweep these highs. Break of structure after a candle closure of this low. This is my entry right here. Liquidity sweep of these highs, break of structure to the downside. I'm not going for Hail Mary setups. I'm going for liquidity. Since we are in a downtrend, right here, I'm going to circle it, after a candle closure under this low, which indicates a downtrend, we are now targeting sell-side liquidity. Because guess what? It is a magnet pulling price down to this level because we can obviously see there are buyers here. And the buyers are putting their stop loss at the lows. So the market wants to stop out the buyers before eventually going higher and sweeping sell-side liquidity, which stops out the sellers that are shorting right here. People are shorting right here and they're putting their stop loss at these highs and they're getting stopped out once the market comes up and sweeps them. So they're sweeping in both ways, right? We want to catch the momentum either up or down, and we're doing that with a break of structure either to the upside or the downside. So in this case, market open, right? And I'm just waiting for the manipulation, right? It manipulates the upside, and I'm waiting for a candle closure to the downside right here, and I already circled it, targeting the sell side liquidity. Right here. And I would have put my stop loss after this fair value gap gets invalidated, targeting these lows. That's a 1 to 3 risk reward. Right? And it's super easy for me to say this in hindsight. This is not me live trading, but this is the model that I use. I wait for a liquidity sweep, I wait for a break of structure to either the upside or the downside, and I target either sell side or buy side liquidity because I'm thinking of it as a magnet, pulling price where it needs to go to stop out orders so institutional buyers and sellers can pocket our money. Right? We don't want them to pocket our money, but if we're uninformed, they will pocket our money. So let's go to another example, right? A random point in the chart, just completely random, and I'll explain to you what happens in the market. Let's go to a random day. You know, let's go clear back to November, right? Let's see what happens in November. Let's pick a random day, 9:30 market open. Right here. Okay, 9:30 market open on this candle. We see a buy-side liquidity sweep, which is the manipulation leg. You guys have to understand that before the market does its big move, its real move, it manipulates to stop out people trying to catch the real move. So right here before market open, you can obviously tell people are trying to go short these buy candles. These are selling candles, these are shorting candles, these are people shorting. And guess what? They're putting their stop loss at the highs, targeting the lows. They're trying to pre-fire the move. Don't try to do that. Make sure you know for sure what's going to happen. So these people that are going short right here are trying to pre-fire this big move down. with the stops at the highs. Pretty simple. Targeting the lows. It would have hit the take profit. That's really good. It's good for buyers and sellers this day. Okay. Accumulation, it chops around. 9:30 market open right here with this candle. Accumulation, manipulation to stop out the sellers trying to pre-fire the big move down. And then after the manipulation leg, it distributes to the lows. So right here we see a low. And then we see a higher low. We see a high, and we see a higher high. That is an uptrend, sweeping out liquidity. Don't get caught in this move. You could have caught this move on this order block, right here. You could have bought and shorted this day. Honestly, this was both pretty good. But what I'm waiting for is the continuation leg, which I would have traded to the downside because my model is waiting for a liquidity sweep and a break of structure. So we get the break of structure after breaking this low, right here. Let me get my brush right here. You see the break of the low. And we don't quite have an inverse value gap anywhere, really. Yeah, this is a really shitty day. I probably would have got stopped out this day. But let's say I just enter off the break of the low, which in hindsight probably would have never happened. I probably would have never got in on this trade. But say we get in, we put our stop loss at the highs, and then we're targeting the lows. But since candle closed under this low, we have a downtrend. So therefore, we are targeting sell-side liquidity. This right here is a magnet pulling price down to that level to stop out people going short. And after it stops out people going short, then it goes back up, right? Because the market likes to rebalance. The market does not like super big moves without a rebalance. Because at that point, it doesn't give institutions time to place the orders they need to place to make the money they want to make. So they don't like big moves like this. So immediately price comes and retraces the move. Immediately. So let me find a better day for you guys. You can really make this clear because that day was pretty shit. Okay, November 26th, 9:30 market open. Right here. We see a manipulation leg high, which it looks like that's all-time highs, honestly. So right there we're trading in the void, right? I don't like trading in the void because there's no targeting liquidity at the buy side. So this is also a shitty day. So at that point, all I'm waiting for is a break of structure to the downside, coupled with the fair value gap or inverse fair value gap. 9:30 market open right here. It already swept liquidity. So at that point, we're at all-time highs. I'm trying to go short. I don't want to keep riding the highs because, like I said, the market likes to rebalance. So we have higher high market open. We have higher highs, higher lows in this uptrend. We get a break of structure after it makes a lower high and a lower low. So here's a high, here's a lower high, here's a low, and then here's a lower low. So at that point, we're trying to go short. So people get in short here off this fair value gap with stops at the highs. Like, I guarantee you a lot of retail traders got stopped out right here. I might have took this trade and I might have got stopped out. So retail traders are coming in right here. They're going short at the retest of the fair value gap with the stops at the highs. Targeting the lows right here. But guess what? The market says fuck you, and the market stops them out before it does the real move down. So this leg right here, I'm going to circle it. This would technically be the manipulation leg right here. This upwards move, because it stopped out sellers going short at this fair value gap. Which, like I said, I'll make an entire video on what fair value gaps are and what breakup structures are. But for now, I'm just using those terms to explain this. So stopped out people going short right there. And our entry is after a break of structure to the downside. Again, so right here we have a low. Right here we have a higher low. Right here we have a high. And right here we have a higher high, which indicates an uptrend, right? What breaks that is a candle closure under the previous low, which would be right here. This is the previous low. So the breakup structure would be after the candle closure of the low. You have to wait for the candle closure You have to, or else you're going to get stopped out. So we see a candle closure at this low, which indicates a downtrend. This is a video on liquidity. So guess what? In a downtrend, we are targeting sell-side liquidity. We are targeting these lows, we are targeting these lows, and we are targeting these lows. Because, yet again, I'm going to say it again, it is a magnet pulling price down. It is trying to grab price and is trying to make it to go to that level so people get stopped out. People are buying right here. Obviously, you can see people buying right here. With stops at the lows, with stops at the lows, with stops at the lows. So the market wants to stop them out as soon as possible, right? The market's goal is to stop people out. So my money goes into their pockets. Which, you don't want that to happen, obviously. You want to win as much as possible. So that's why we're being diligent, and that's why we're making videos right now, so you guys can learn and be profitable. So right here, we see a break, and then let's just say we enter here. After we see a break to the downside. Coupled, you know what, coupled with an inverse fair value gap, because I see one as well. Right here. Size doesn't matter. Really skinny inverse fair value gap. So let's say we wait for liquidity to sweep, break up structure to the downside. After this candle closes under this low right here, inverse fair value gap right here. And we enter off of the inverse fair value gap, because that's our model. Stops at the highs, targeting the lows. That's a negative risk reward. And target these lows or these lows. I don't like negative risk reward. Why would I be risking more than I could potentially make? That's stupid. So I put my take profit at these lows, and then that'd be partials, and I put my full take profit down here. Of course, price comes down, sweeps the lows, because these lows are magnets pulling price down. Wasn't the best example, wasn't the cleanest price action, so I'm going to do another example. Yeah, okay, I want to see like an accumulation level. Okay, this is pretty good over here. This is good stuff right here. I like this. Okay, this is a barcode price action. This is super choppy, right? Pretty shitty day. After I see this, I'd probably avoid trading that day. Or I just patiently wait for a liquidity sweep. Which we get a sell-side liquidity sweep right here after the sweep of the lows, right? So immediately market opens. Nothing really happens off bat except it sweeps these highs. But like it's super choppy. I don't know if I would trade that or not. But I'm waiting for a sweep of the lows. Like say I am, right? Market sweeps the lows in a downtrend, and we break structure to the upside because we have a higher high, right? Here's a high. Here's a higher high. Here's a low. Here's a higher low. Right? Therefore, we're in an uptrend. Liquidity sweep right here. Sweeps liquidity right here. Break of structure to the upside. At this high right here, it broke structure to the upside because it broke this high. Right here. Candle closure above the high, which indicates an uptrend. Liquidity sweep, break of structure higher. Inverse fair value gap right here. Our entry would have been right here, stops at these lows, targeting the intern highs. 1 to 1.4 risk reward, right? Sell side liquidity sweep, which is the manipulation leg. Break of structure to the upside right here. Candle closure above the previous high. Keep losing my brush. Right here again. Inverse fair value gap. Price, like I said, price likes to retest after a big move. Price retests this gap, fills in the imbalance, and then pushes to these highs. And guess what? These highs are magnets pulling price up because we are in an uptrend. Please get that clear. In an uptrend, we are targeting the highs. In a downtrend, we are targeting the lows. It is that simple. Do not overcomplicate it. Please. I'm going to do a few more examples. Really need you guys to get this. This is extremely important. Okay, this is a slower day, right? Let's go to a slower day. Okay. Right over here, right before the big move. Okay, this may be a good example. Okay, November 20th. 9:30 market open, right here. Immediately, market opens and sweeps these lows over here. Bang, liquidity sweep. What are we waiting for after a liquidity sweep? A break of structure to the upside. When do we get that? We get that after a candle closure above the previous high. This is a high. We barely get a candle closure above the high. But we still get a candle closure, even if it's barely. Therefore, since we are in an uptrend, guess what? We are targeting buy-side liquidity. Bang. Not really an entry here. This is a pretty shitty day. There's no inverse fair value gap, so most likely I wouldn't have taken this trade because my confluences weren't set up. But even with just a break of structure to the upside, we're targeting buy-side liquidity. So say we do enter off of the break of structure right here. Stops at these lows, targeting the highs. Yeah. Sorry, my buddy was talking to me. Okay, anyway, targeting the highs. This is a magnet pulling price higher, right? Targeting the highs. This is a really shitty risk reward. This is a terrible trade, and I would have never taken this trade because we didn't get the fair value gap, right? But we still target the highs. This is still a magnet pulling price up because we're in an uptrend, right? I'm going to get you a better example. I'm going to keep going until I find the example that I like the best. So, like, you're not going to trade every day. The best traders in the world do not trade every day. Some very good traders trade high-impact news. Other traders avoid high-impact news. Me, personally, I like high-impact news because it creates volume in the market. News hits, big volume, right? I just did a video on news, so if you didn't see that, go watch that. I explained the news. Okay, let me go to a random day. All right, this is a video on liquidity. I got to keep remembering that. Okay, random 9:30 market open. Okay, this looks like a really good example. I can just tell already. Let me zoom in. Perfect, right? 9:30 market open, bang. Sweep doesn't quite sweep liquidity to the downside. It doesn't quite take these lows. So that's not a confluence. But what it does do is sweep the highs. Sweeps these highs, it sweeps these highs. That's our liquidity sweep, right? Liquidity sweep, break of structure to the downside with a candle closure under this low right here. Bang. Break of structure to the downside coupled with an inverse fair value gap. This is amazing. The manipulation leg caused the inverse fair value gap. That is our entry. That is almost to the tick perfect. Stops above the highs. Targeting just the lows. You could target these lows, and I would be targeting these lows. Whatever you want to target, just make sure you win. Whatever you do, just make sure you win. Targeting those lows. So again, accumulation, price manipulated to the upside to sweep liquidity, distribution to the downside. The sell side was the real move. Think about these lows right here as a magnet pulling price down. There's not even lows like over there. I'm not scrolling out that far, but yeah. So manipulation higher to stop out sellers because people are going short here, right? And we can tell people are going short because of this massive move down, right? This is a minute after market opens. We see this massive move down, so that's how we know people are going short, and that's how we know people are putting their stop loss at the highs. People are going short right here, and they're putting their stop loss at these highs. They're putting their stop loss at these highs. So guess what? The market wants to stop them out before doing the move because they don't want shorters to catch the entire move because that means less money in their pockets and more money in our pockets. They don't want that. So they're stopping out retail as soon as they can. So as soon as market opens, they're stopping retail traders out that are going short and pre-firing the move down because they don't want us to make as much money as possible. It is our job to understand that the market is manipulative and it's going to stop us out before the real move happens. And it's our job to avoid that. And that's exactly what I'm teaching you guys, how to avoid the manipulation and how to catch the moves that the institutional buyers and sellers need to make. They need to make these moves. They need to make the moves down. Because this is money, right? The bigger the moves, the more money they can make, right? Again, it's literally just a magnet pulling price down at that point because we saw a break of the low. It happens time and time and time again. We see market open. We see manipulation either to buy side or sell side liquidity to stop out buyers and sellers. And then we see a distribution or continuation to either buy side or sell side liquidity. All we're looking for is highs and lows. That is it. Do not overcomplicate it. Think if you were a dumbass motherfucker, where would you put your stop loss? It is your job to enter where you would have put your stop loss if you were a dumbass motherfucker, right? I'm teaching you how to be smart, not dumb. All right, let's do another example. Okay, 9:30 market open, November 13th. I don't know what the hell happened this day, so we're just going to do random days. We're just doing random days. No clue what happened this day, right? This looks like a continuation model. Market open, bang. We see a candle closure under the slow. We are obviously, and then previous to that, we are obviously in a downtrend, right? It looks like the market's just landsliding. So we're just looking for shorts either way. And we can really get them. Candle closure under the slow, right? So how I would have traded this, and I may have gotten stopped out. You'll see. We'll test this. How I would have traded this was this bearish fair value gap. We see a break of the low, indicating a downtrend, and we see a retest of a fair value gap. Because like I said, market likes to retest. The market just doesn't fall forever, and it doesn't buy forever. It has to come back and retest certain points so institutions can place their orders where they need to place them. So right here, there are orders being placed, sellers being placed, and you can tell because price reacted off of it. It wicked into it twice. Price reacted off of it twice, and it sold. People are going short here, right? I would have gone short here, right? Because this is my model. Liquidity sweep, break of structure. Actually, you know what? I'm a fucking idiot. It never swept buy side liquidity. I'm not even in this trade. But let's just say I am in this trade. Let's get in short right here after the retest of the gap. Let's see if we can get stopped out here. I'm putting my stops at the highs right here. And I'm putting my take profit at the lows, like way over here, right? I'm putting my take profit at like these lows over here. So whatever that is, like let's just say it's down here. Okay. So this is a really tricky day, right? Market is in a downtrend. There wasn't really manipulation like right off market open, right? It was just continuation down. We wouldn't have gotten stopped out on this trade even if we took it, right? If we put stops at the highs, we would not have gotten stopped out. We would have had a 1 to 7 risk to reward, right? But you see price wants to manipulate people like me and make me lose money because that's money in their pockets, right? But we didn't quite get stopped out, didn't quite sweep liquidity, so we're good. So I would have entered off this fair value gap, and I would have been targeting these lows. What's that? 1 to 4. But these lows is a magnet pulling price down. I'll say it a million times. That day wasn't really a good example because it was kind of choppy. And okay, let's go to another day. I'm going to keep going until I find a really good example for you guys. I want to make it super duper clear. I need to make this clear for you guys. It is my job to make this as clear as possible. I think I already said that. I need you guys to become profitable. It is urgent. You guys have to become good traders before it is too late. I swear. It is going to be too late someday. Be a profitable trader before it is. Or else you will really regret yourself. I promise you, you will regret it. If you do not learn a high income skill such as trading, you will regret it. I promise you. And I really hate to say that. It's really sad that I have to say that, but we both know that this world is fucked. And if you don't make a good, rich living for yourself, you are fucked. Your bloodline's fucked. Your future generation's fucked. Your future kids are going to be enslaved by the government if you do not make money. It is that urgent. I'm teaching you guys and giving you free information online so you can pull money out of the markets and retire yourself and your future family. Please understand this. Liquidity. Holy shit. 9:30 market open, bang. Market was accumulating before that. Guess what? Manipulation to the upside to stop out sellers. And we know there are sellers because we see this move down. These are sellers right here. And guess what? They're putting their stops at these highs right here. And they're putting their stops at these highs. So guess what? The market manipulates to those highs so it stops out the shorters before the real move happens, so they lose money, and it prevents them from making a lot of money, right? Because if they would have caught that entire move as shorters, they would have made a hell of money, right? So guess what? Accumulation, manipulation to the upside, and then distribution to the downside. Let's see how I would have entered on this. So I get my liquidity sweep. Now all I'm looking for is a inverse fair value gap. So there's not gaps anywhere here, not that I see yet. Yeah, this is a pretty bad example because we do not have a gap. Interesting. Okay, anyway, I manipulated and then dumped, right? So let me just call out a break of the low. We are in a downtrend at this point, and I'll tell you why. We made a high after the liquidity sweep, buy-side liquidity sweep. We made a high. We made a lower high. We made a low. Then we made a lower low, indicating a downtrend. And when we are in a downtrend, we are targeting sell-side liquidity. It's that simple. So say you would have traded the break of the low. You didn't even fucking wait for a fair value gap. Didn't wait for shit. You just wanted to break a structure to the downside because you're bearish that day, whatever. We get the break of this low, and we're targeting, this is like a negative risk to reward. But I'm just doing this like, just for an example, right? I've never taken straight because we didn't get the fair value gap we needed. Stops at these highs. And then actually, yeah, let me like professionally do this. And I'm going to put my take profit at these lows. My partials would be here, right? Because we see these lows over here. This is liquidity right here. This is a magnet pulling price down. This is sell-side liquidity. Price needs to go here to stop out people going long. Please understand this. It has to go to certain spots so people lose money, so other people make money. And by other people, I mean evil Jewish people that run the markets and run Goldman Sachs or wherever, bro. Bang. Do not demonetize me, YouTube. Because you know it's true. You know it's true. So what is that? A 1 to 1.6 risk to reward right there. Just trading the break of the low. Okay. But here's where we really enter. We see a break of structure to the downside again. Because we see a break of the most previous low right here. We see a break of this low. But with a candle closure under it. A candle closure. You have to understand you have to wait for a candle closure. Else you're going to get chopped out. We see a candle closure under this low, which indicates a downtrend. Liquidity sweep to the upside, break of structure to the downside, and this is our massive inverse fair value gap. This is where the professionals got in. Right here. This is where the real men, the real people with real balls, with real testosterone got in right here. And they got a massive risk to reward. Because they're men and they have patience and they waited for a break of structure to the downside and they waited for an inverse fair value gap. Right here. Tap into the gap. Right here. Targeting the lows over here. Partial take profits at this low. Full take profit at this low. Again, I'm going to say this again. These lows are magnets pulling price down. It's trying to grab price and it's trying to pull it down as hard as possible. Please understand this. I'm going to do one more example because that example is pretty good. Yes. I'm extremely passionate about this because you guys do not understand how urgent it is that you learn this now and you take advantage of this now before it's too late. I worry about you guys because you're not locking the fuck in when you need to. Okay. 9:30 market open. This is a continuation model. We see a break of the high. Right here. Let me take this away, but that's where market open is. A break of the high because of a candle closure. Okay. Candle closure, which indicates an uptrend. Fair value gap. So at this point, all I would be waiting for is a tap back into this fair value gap right here, which we never got, right? So I'm not really trying to get into this trade. And if you try to jump the gun up here, you may get stopped out, right? So I wouldn't have taken a trade this day because it didn't really manipulate to the downside. We didn't really get a liquidity sweep, and we didn't really get a fair value gap filled. Shitty example, right? But if you were strictly trading break of structures, you would have got a pretty good RR right here. You would have got the... And right here, something called a squeeze. And I'll make a whole entire video on that. But basically, people are getting stopped. People going short right here were getting stopped out. So when shorters are getting stopped out, they have to buy back the market. So as soon as it taps into this high, shorters that are getting stopped out are buying back the market, and institutional buyers are also buying the market at the same exact time. There's like a double whammy. Double buyers, bang. Launches price up. It's called a squeeze. I'll do an entire video on that. So I want to find a really good AMD model, accumulation, manipulation, distribution, because that's pretty much what I'm teaching with this liquidity video. Okay, let me go to another day. I'm gonna find one. I'm not stopping until I find a good one for you guys. Holy fucking gap. Ha! Okay. I might be started, Bear. I might be restarted. Yep, I am. Okay. This is also a continuation model. Wow, okay, and bad example. I'm not even going to explain to you that one because I just explained to you a continuation model. Okay, fuck, I really need to find AMD. I understand how to trade both, right? Because I'm an open-minded trader. As a trader, you have to be as open-minded as possible. Oh, people are like, oh, you have to stick to a certain strategy to become profitable. Absolutely fucking not! No! Learn as many strategies as possible. You have to be open-minded. Learn as much as possible. Do not be closed-minded to a singular strategy, because then you're not going to know how the market actually moves when you need money, bro. If I need to get into the market and I need to hit a banger because I need to pay my fucking rent, I need to learn how to trade everything. I need to learn how to trade continuations. I need to learn how to trade retests. I need to learn how to trade order blocks, breaker blocks, liquidity. I need to learn everything, right? As a trader, you need to know everything. You need to, or else you're going to lose. But as a beginner, you should stick to one strategy. So let me find a good example. Sorry for that fucking rant. I had to rant. You guys need to understand how important this is to understand this. Dude, these are all continuation models. This may be a good one. This looks actually great. Yes. Perfect. Okay, market opens with this candle, right? We see an immediate sweep of the lows. Couple minutes after market opens. Market sweeps these lows right here, bang. That's my liquidity sweep. Now I'm simply waiting for a break of structure to the upside. We get that break of structure after a candle closure above the most previous high, right here. So here's a high, and we see a candle closure above the previous high. And I'll circle it for you guys. Right here. Perfect candle closure above the high. Therefore, we are in a break of structure to the upside. Guess what? When we are in an uptrend, we are targeting buy-side liquidity. So right after that, I'm pretty much just waiting for a fair value gap, which we don't even really get. We don't get a retest of the gap because it's just a squeeze, like I said earlier. It's just a squeeze to the upside. So let's just say we enter off the break of this high. Creates a squeeze because sellers are getting stopped out and institutional buyers are stepping in. And we're putting our stops at the intern lows. Intern lows, because if you put your stop loss here, you're risking too much at that point. You don't want to risk too much. Stops at intern lows, and then targeting really good right here. We're targeting buy-side liquidity. We're putting partials here, we're putting partials here, we're putting full take profit here. And potentially we're putting full take profit clear up here if you're a swing trader. But we're not swing traders, we're trying to get in and out. It is your goal as a trader to get in and out without risking anything. So as soon as we see a break of this high, I'm moving my stop loss to break even immediately. Because that's your goal as a trader. You want to be risk off as soon as possible. So liquidity sweep again. Break of structure to the upside. Therefore, we are targeting buy-side liquidity. A break of the upside means buy-side liquidity. A break of the downside means sell-side liquidity. These levels are magnets pulling price higher. I'll say it 1,000 fucking times. These are magnets pulling price higher. So try and grab price and pull it up to stop out sellers. And so institutional buyers make their money. So that's what we're targeting as a retail trader. Liquidity sweep, break of structure to the upside. Targeting buy-side liquidity. And you could have waited and traded this fair value gap right here. Let me super zoom in right here and make it perfect. Look at that. Perfect retest into a fair value gap. Wow, isn't that crazy how that works? Targeting buy-side liquidity. One more example for you guys. I have to make sure you understand this. I have to. Doing all that I can in my power to make sure you understand this, guys. You have to. It's up to your fucking bloody... Oh, amazing. This looks amazing. I'm loving this right here. Absolutely loving this. Market opens. Wow. Immediately sweeps buy-side liquidity. Sweeps buy-side liquidity. Breaker structure to the downside. Inverse fair value gap. We are entering after a candle closure under the gap. This is a bullish fair value gap until we get a candle closure to the downside. Right here. Here, let me circle it. We get a candle closure right here, which makes this an inverse gap. And let me do this a little better. Let me make this perfect for you guys. Let me take this away right here. Zoom in super close. Inverse fair value gap. We are entering at a candle closure, which inverses the gap. Which, like I said, I'm going to make an entire video on fair value gaps and breaker structures, all this. But I'm using these terms right now so I can explain this, right? But I'm just going to circle exactly where the break was right here. So literally right here, it breaks these lows, and then the candle closes right here. So we get an inverse gap in a break of structure in a single candle. Literally, a beautiful trade. Beautiful. I'm loving this shit right here. We are entering off of the inverse fair value gap. Wow, I am really slow right now. Holy shit, dude. Fucking uncle. Okay. Stops at the highs. Guess what? We are targeting sell-side liquidity. Amazing liquidity pools. We're targeting these lows, these lows, these lows. Fuck it. These lows. Fuck it. We're targeting the edge of the universe, bro. We're targeting these lows. And isn't it so fucking funny how it perfectly taps in to this low right here? Because guess fucking what? This low is a magnet pulling price down because we are in a breaking structure to the downside. Mind blown! Let me explain this to you one more time so you understand this. Please understand this. Accumulation. This is accumulation right here. Before market open. Market opens on this candle. Immediately sweeps liquidity. Bang! Sweeps liquidity. After liquidity sweep, we're waiting for a breaking structure to the downside coupled with an inverse fair value gap, which we get perfectly right here. Amazing. And we are getting in after a candle closure under the low. This is I would have made so much money this day. It's not even fucking funny. I'm not even being egotistical. It's just because I know the markets and I know how they move. And I want you guys to also capitalize on moves like this, because this is beautiful. Let's see what RR that is. Man, that's like a 1 to 3. It was 1 to 4. Amazing. Amazing trade. And that was so good. And that hyped me up so much that we're going to do another one. Fuck it, you guys have to understand this. Okay. Now I want to get a shittier one, because that one was so good. Bang, 9:30 market open October 31st. Fuck, can't talk. So this is a continuation model. So pre-market, we're already in a downtrend, right? So we're targeting the lows immediately because we're in a downtrend. Simple. Said that 100 times. So these are draws of liquidity. Bang. But market open already swept that. Yeah, these are draws. Lows are liquidity. Highs and lows are liquidity. Again, I'm going to say that. These lows and these lows. Again, a magnet pulling price down. Probably getting tired of me saying that. You have to understand it. So market opened right here, and we do not see a fill with it, right? Yeah, shit day. But this is a continuation model, right? And we're seeing a squeeze of these lows because buyers are getting stopped out, therefore they're selling. I'm talking about these lows right here. So say you take a trade off the break of structure to the downside, which you have to be an extremely experienced trader to confidently do this. Break of structure right here, which creates a squeeze. Because people are buying, you can obviously see people are buying here because guess what? Price is going up. If people buy, price goes up. If people sell, price goes down. People are buying right here with stops at these lows. But we're in a downtrend, so why the fuck are people buying? But people are buying because we can see the price going up. It is our job to catch the break of the low. We catch the break of the low targeting liquidity. That's a 1-to-1 risk to reward right there. And obviously price continues to dump, right? That's the continuation model. One more, because I want the AMD, because AMD is easier to understand for new traders. Yeah. As soon as I find another AMD, this video is over. Yeah, once I start posting more, I'm gonna edit these videos and I'm gonna like put text and everything. But I just need to get used to talking to a camera, because I'm not used to that yet. Okay, market open, right? Immediately tanks and sweeps these lows. We're in a downtrend, therefore we're targeting these lows. But we're not looking for the downtrend, we're looking for the reversal up. Because that is the manipulation like that. Accumulation, manipulation to sweep the lows, distribution to the upside. I'm entering off this inverse fairway gap. Sweep of the lows, liquidity sweep. Break of structural upside, you see right here. So we have a high right here. We have a low right here. We have a higher low right here. And barely a higher high right there. Higher low, higher high. Uptrend. Higher lows, higher highs mean uptrend. If we are in an uptrend, guess what? We are targeting buy side liquidity. Amazing. You guys get it already. And we are entering off of the inverse fairway gap. Liquidity sweep, break of structural upside, inverse fairway gap. Our entry would be right here perfectly. Bang. Stops with the lows, targeting previous highs. 1 to 1.5 risk reward. Bang. If you guys don't understand this, I do not know what to tell you. I don't. I really don't. You guys need to quit immediately. If you guys do not understand what I'm saying right now, please go watch somebody else. Or just quit. Seriously. I really need you. Watch this video a million times. Magnet pulling price to where it wants to go. If it's in a downtrend, the previous lows are magnets pulling price down. If it's in an uptrend, the highs are magnets pulling price up. That fucking simple. I showed you 100 different examples. Please take this as you will and use this to your advantage and live the life you have been dreaming of. Please. Next video will be on fair value gaps. I will see you in the next vid. Thank you.